Home ownership is a wonderful thing and something most of us strive for. I personally experienced the real estate bubble pop in the mid 2000s, and there's a lot of speculation nowadays about where the current real estate market is heading and whether or not there's a real estate bubble pop on the horizon this year in 2022. So I'm tackling this topic head on today. I'm going to share with you my personal experiences during the financial crisis 15 years ago, specifically around 2006 and beyond. And I'm also going to share with you some really good information regarding today's housing market and if there's another bubble pop coming or just a market shift correction. So if you're ready, let's go. If we haven't met yet, I'm Sue Singleton with Coldwell Bankers Seacoast Advantage here in beautiful southeastern North Carolina. Now, back in the mid 2000s, as the housing market bubble was building, I was actually working as a real estate paralegal. Now, this was way back before I became a real estate agent, and honestly, I saw loans being made back then to folks over and over and over again. Well, it didn't take a rocket scientist to know that a lot of these folks buying were going to be in trouble down the road. Time after time after time, I witnessed my lead attorney talking with folks about the consequences of the home loans they were entering into to make sure they understood the terms of the loan as well as the consequences. Now, the craziness of all that back then is that these loans did actually give folks the opportunity to experience home ownership, but a lot of it came at a huge cost for many people later on. There were many closings where buyers had to bring little or no money to closing. There were folks getting loans that, even though they only needed to bring in, many cases, less than $100, they didn't have the money at closing, which resulted in the closing having to be rescheduled for a couple of days down the road until payday, or the buyer would leave and come back in an hour or so later with the money. Honestly, it was a little unsettling to see folks going into these types of loans. But as my lead attorney kept telling me during that time was all we could do was present the information, present the facts of the loan, and it was up to the buyer to decide if they wanted to proceed. Now, also keep in mind that it wasn't just folks buying homes that were getting these subprime mortgages. There were also a lot of homeowners who were doing cash out refinances or obtaining home equity lines of credit because home values had risen so much higher during that period of time, similar to what we've seen over the last year. Now, during that time, also, banks, as a matter of course, added home equity lines along with the borrower's initial mortgage. And then foreclosures started slowly at first, and then they started flooding the market. Many of the foreclosures around southeastern North Carolina were manufactured homes that had been purchased and financed as land home packages, but there were lots of other homes as well. And so, as the foreclosures mounted, the financial market crashed and housing prices dropped like flies. But it wasn't just houses. Many people were buying lots at premium prices during that time also. And as the prices dropped, so did the lot values. Many subdivision developments came to a dead stop, and many developers went into bankruptcy. Lots that had been purchased for a premium price, like 200,000, all of a sudden were worth only 20,000. There were $1 million lots that all of a sudden were only worth 100,000. Many of the subdivision developments became dormant and were stagnant for years and years. Many real estate attorneys whose main real estate practice focused on doing loan closings didn't survive. I was fortunate in that I was working with attorneys during that time whose real estate practice also included all types of real estate litigation. So I was very blessed that it did not have a major impact on my job, but there were many that were not that fortunate. So all of that leads to how nowadays lots of folks are worried about the rising interest rates, the rate at which the home values have risen over the past couple of years, especially in 2021. And then we factor in COVID, the shortages in building materials, and the supply and demand for houses in the current real estate market. Whew, I don't know about you, but it makes me tired just thinking about all that. But lately, I've been getting this question a lot, and that is, What caused the housing crisis or the housing crash 15 years ago, and is it going to happen again? And the frequency of that question is actually what led to the subject matter of this video today. Now, I don't have a crystal ball. I can't predict the future, nor am I a financial advisor. But what I can do is share with you some really good information that may help shed some light on the answer to that question. Some experts are suggesting that there's going to be a market reset, a market correction, a market shift. Those are all the buzzwords going around. But those are all totally different than the market crisis or the bubble burst 15 years ago. Some experts suggest that the market is actually going to shift back to a more neutral market where buyers aren't having to pay $50,000 over purchase price, not having to waive home inspections and appraisals in order to get their offers accepted. Many experts from across the country have said that the overheated market of 2021 was not sustainable, which was fueled not only by the supply chain shortages, but also by the fear of many, especially millennials, who had cash to buy and were being fueled with the fear of missing out. But even with all of these factors, expectation is that a market housing correction would not and should not be compared to the crisis 15 years ago. So let's take a look at some other information. Most of us would probably agree that home ownership has become a major element in achieving the American dream. A recent report, actually from the National Association of Realtors, finds that over 86% of buyers agree homeownership is still an American dream. Prior to the 1950s, however, less than half of the country owned their own homes. However, after World War II, many returning veterans used the benefits afforded them by the GI Bill to purchase a home. And since then, the percentage of homeowners throughout the country has increased to the current rate of around 65.5%. That strong desire for home ownership has kept home values appreciating ever since. Now, look at this graph, which shows home price appreciation since the end of World War II. Notice that on the graph, it shows the only time home values dropped significantly was during the housing boom and bust of 2006 to 2008. If you look at how prices spiked prior to 2006, it looks a little bit like the current spike in prices over the past 2 years. Now, that may lead some people to be concerned we're about to see a similar fall in home values as we did back then. To help alleviate these worries, let's look at what happened last time and what's happening today. One of the biggest factors 15 years ago was that foreclosures drove down home values dramatically. There were two main reasons for the flood of foreclosures. The first one was that many purchasers were not truly qualified for the mortgages they obtained, which led to more homes turning into foreclosures. Now, I shared with you earlier in this video about how I saw buyers who were only needed to bring less than $100 to closing who didn't have the money readily available. There were also many buyers who didn't have to bring any money to close it at all, and it wasn't unusual for a buyer to actually get money back at closing. Now, the other reason for the flood of foreclosures was that a number of homeowners cashed in the equity on their homes. When prices dropped, they found themselves in an underwater situation where the home was worth way less than the mortgage on the home. Now, many of these homeowners who could no longer afford their mortgage payments, well, they just walked away from their homes, leading to even more foreclosures, lowering neighboring home values even more. This cycle continued for years, but slowly and gradually, the market started to recover. So, why is today's real estate market different? Well, here are two reasons why today's market is nothing like the one we experienced 15 years ago. So, for starters, today, demand for home ownership is real, it's not artificially generated. So, listen, running up to 2006, banks were creating artificial demand by lowering lending standards and making it easy for just about anyone to qualify for a home loan or refinance their current home. Today, purchasers and those refinancing a home face much higher standards from mortgage companies. So, data from the Urban Institute shows the amount of risk banks were willing to take on then as compared to now. Now, listen, there's always risk when a bank loans money. However, leading up to the housing crash 15 years ago, lending institutions took on much greater risk in both the person and the mortgage products being offered. Now, that led to mass defaults, foreclosures, and falling prices. Today, the demand for home ownership is real. It's basically being generated by a reevaluation of the importance of home due to a worldwide pandemic. Additionally, lending standards are much stricter in the current lending environment. Purchasers can afford the mortgages they're taking on, so there's little concern about possible defaults. Now, perhaps you're still worried about the number of people that are still in forbearance. The experts say that there's virtually little to no risk of that causing an upheaval in the housing market today, which would create a flood of foreclosures. So the next one, people are not using their homes as ATMs. Now, back in the early 2000s, they did. As mentioned above, when prices were rapidly escalating in the early 2000s, many thought it would never end. So they started to borrow money against the equity in their homes to finance things like new cars, boats, vacations, put it in swimming pools, and other things. And when prices started to fall, many of those homeowners were underwater, leading some to actually abandon their homes. This increased the number of foreclosures as well. Homeowners haven't forgotten the lessons of the crash as prices skyrocketed over the last couple of years. Black Knight reports that tappable equity, now that's the amount of equity available for homeowners to use before hitting a maximum of 80% loan to value, has more than doubled compared to 2006. Also, the latest homeowner equity insights report from CoreLogic reveals that the average homeowner gained $55,300 in home equity over the past year alone. The deputy chief economist at First American reports that homeowners in the fourth quarter of 2021 had an average of $307,000 in equity. That's a historical high. ADS reveals that 41.9% of all mortgaged homes have at least 50% equity. These homeowners will not face an underwater situation even if prices dip slightly. Today, homeowners are much more cautious. So, what's the bottom line? Well, the major reason for the housing crash 15 years ago, as we discussed, was a tsunami of foreclosures. And with much stricter mortgage standards and a historic level of homeowner equity, the fear of massive foreclosures today isn't realistic according to the experts. So the question remains, will there be a slowdown in the market? Well, possibly so. But even with that, there should be only a slight downward bounce in the market values. Now, as I said before, I don't have a crystal ball and I can't foretell the future. But as you can see from the information discussed in this video today, the market today is way different than that which caused the crash 15 years ago. Have we reached a tipping point where we're going to see a market correction? Well, many experts believe so. And they say that there are a couple of pointers that we can actually look at. And one of those being the buyers are cooling off and they're stepping away from making multiple offers on properties. Now, multiple offers are still happening, but the numbers have decreased significantly. Buyers are taking much more time in making their decisions. And lenders and financial advisors say that the rising interest rates are also impacting buyer decisions. But even if we are in or close to that tipping point of a market correction, most experts believe that it would not be comparable to or close to what we saw in the crisis 15 years ago. So please keep in mind that nothing I've discussed in this video today should be construed as investment advice. You should always obtain professional advice from your own advisor before making any investment decision. I hope you found the information in this video today both informative and helpful. And whether you're looking to upgrade to a home that will better suit your lifestyle, looking to purchase your first home, your vacation home, investment property, or perhaps you're even looking to sell your home, let's connect so you can stay updated on what's happening along the Carolina coast and in all of southeastern North Carolina. Please feel free to reach out by phone, text, or email. And if you haven't already, I would appreciate you hitting the subscribe button below, liking and sharing this video. And don't forget to leave me a comment. I'd love to hear from you. And remember, happiness grows here. I'll talk to you next time.